Welcome back to the Rose Bros podcast. This episode, we are joined by Phil Hodge, President and CEO of Pinecliff Energy. Pinecliff Energy is a public company actively engaged in the exploration, development, and production of natural gas, crude oil, and natural gas liquids in Western Canada. Pinecliff currently produces approximately 21,000 barrel of oil equivalent per day and trades on the Toronto Stock Exchange with a market cap of approximately $400 million. As commodity prices continue to rise in 2021-2022, Pinecliff has enjoyed enormous gains, including a 45% free cash flow yield, plans to eliminate all debt, and its first dividend scheduled to begin in May of 2022. With a single-digit decline rate on production and the industry average at approximately 30%, Pinecliff plans to continue its steady rate of growth as the Canadian energy industry recovers. We sat down for a smooth cup of Rose Bros coffee and discussed why natural gas prices are rising, the resulting capital allocation process and how it affects shareholders, the realities of a transitioning energy industry, how the invasion of Ukraine has affected global energy security, and a lot more. Also, this episode is available on YouTube, so if you enjoyed the conversation, subscribe to the Rose Bros channel. It will go a long way to helping the show. This week's podcast is brought to you by A1 Media. Looking to grow your business online? A1 can help grow your business through its bundled media packages, including a website, newsletter, social media accounts, e-commerce storefront, or a podcast. Let A1 help tell your entrepreneurial story and reach millions of new customers. Check out a1dev.ca today for more details on how you can grow your business. Why don't we start? Phil Hodge, I really appreciate your time.
Well, thank you. I'm looking forward to this.
You are the CEO of Pinecliff Energy. What is Pinecliff Energy?
Pinecliff is a company that I was employee number one in January of 2012. And the model was always to create a natural gas-based dividend company. That's the real crux of it. And my chairman was the one who brought me into Pinecliff. Pinecliff already was an existing public entity. It used to have some South American oil and gas assets. And a gentleman by the name of George Fink was the CEO and chairman, very well known in Calgary for many, many years of running Bonterra. He still is the CEO of Bonterra Energy. And that was his kind of light oil vehicle. He also had a mining vehicle that was sold for $750 million to Agnico Eagle. So he did mining. And then Pinecliff was going to be the natural gas entity. And our view was, and continues to be to this day, matter of fact, I'd say it's now even more bolstered than it was 10 years ago, is that natural gas is going to be a very important part of the future. So the goal was George's secret sauce to creating a dividend company. And he's done, on that one tangent, George has paid $1.3 billion of dividends to shareholders of Bonterra. And he owns 10% of the company. So obviously he's done very well under that model. It was to create the same thing on natural gas. And the secret sauce was low decline. That if you really want to create a really sustainable dividend model, you needed really low decline. So anybody who's been around the oil and gas industry knows that the lower decline comes from older assets, more legacy assets, not the flush production that you get from the big wells that you hear so much about in the Montney and Duvernay and other areas. And so that was where we started. We started with 100 barrels a day of production, non-op. So non-operated. I've done 11 acquisitions since then. And today, as we enter into year 11, we're now over 21,000 BOE a day, about 90%, 90% gas, with the lowest decline rate, I think, of any public company in North America. I shouldn't go as far as, for sure, Canada, but I don't know if anyone else has got a 6%, 7%, which is kind of where our base production decline rate is.
Low cost, low decline.
Yeah. So we run lean, as you can see, as you've visited our offices. That's always been the model, and that's what's allowed us to survive through some tough years. I mean, 2019, 2020 were really difficult years. Those, we had, the worst natural gas prices, the worst AECO natural gas prices in 30 years, which is an important distinction because actually NYMEX and Henry Hub, the U.S. natural gas prices weren't bad. They weren't great, but they weren't bad. We had a real differential blowout between the two, between Western Canada and Eastern Canada. And that was mainly because we had oversupply, or you could say under capacity. Either way, we were the system was full. And so, gas was not, it had nowhere to go. And that's that's the same thing we've seen on oil when it had its negative days, is if it's got nowhere to go, then it goes no bid. And so that was some lean years, 2019, 2020. But we're proud to say that we made money every single year that we've been in existence, even with those roads. So it goes back to the point you just made, the low OPEX, the low G&A. We just run things lean. We don't have a lot of managers here. We're doing 21,000 BOE a day, and we've got 33 people here in head office. So it's we run lean.
You're a lawyer by training.
Yeah.
Did you always plan to get into the energy industry? What motivated you to move over to business?
I don't think I ever had I'm a bad guy to say, did you have 5-year plans, right? I've never had one of those. It was always just kind of, I spent 10 years. I was a partner at Bennett Jones, which is a large law firm here in Canada, but is based in Calgary. I think I always knew that I wanted to get out and be on the entrepreneurial side. My father was very much an entrepreneurial in small town Alberta, had many businesses. I think it was kind of something I always wanted to do. That being said, I really enjoyed my time as a lawyer. I did a lot of corporate M&A. I think it gave me a great background to what I do now. So dealing with transactions and the regulatory and the legal aspects of deals, it comes very naturally to me. But yes, I spent the first 10 years, and then I joined a client that encouraged me to come out and move to Vancouver. And it was a company called Westport Innovations. And that was a company, and that's where my energy started. I mean, I'd done a lot of energy work when I was a lawyer, but the Westport Innovations is a technology company that allows heavy duty vehicles to convert from diesel to gas and keep the engine, change the fuel is the kind of fuel they say. It's still a very successful company that's now selling into 70 different countries. And I've just actually rejoined their board here recently. I love the fact that they're on the cutting edge of kind of the transition, the natural gas to hydrogen. So I did that for 5 or 6 years. Then came back to Alberta and went into the investment banking world. And that was another 5 or 6 years, a very good time to be in that world. It was kind of, the 2006 to 2010, 2011. That was a very busy time for M&A transactions and financings. And so it was pretty exciting. We did, our biggest deal that we did turned out to be tied to my connections that I had made through Westport, which I spent a lot of time in China. I've been to China 40 or 50 times. And the last deal I did as an investment banker was an energy deal, which was CIC, which is the Chinese Investment Corporation. One of the world's biggest sovereign funds invested $1.2 billion in PennWest. After the deal, PennWest asked if I'd come over and run their business development group. I did that for about a year until George came over and asked me if I'd like to start up Pinecliff. And so it was an opportunity for me to invest in myself, which I always encourage people to do if they get the opportunities. So at the time, I scraped up all I could, and we put $1 million into Pinecliff. I've never sold a share of Pinecliff. I continue to add to Pinecliff. So now this is now the longest I've ever been at any position. This is my role in Pinecliff.
Skin in the game.
Yeah. Yeah, I think it's key. When I'm an investor looking at, that's one of the, and again, George Fink, I've been fortunate enough to have a mentor like that. I mean, he always owns a lot of stock of every single company that he's been involved with. And I think it creates an alignment. I think when I talk to shareholders, I say, look, if you're CEO of a public company, you better have thick skin, because people can criticize you. They can say whatever they want about you, and you've got to, but I always tell people, you can criticize any decision I make, because I very well may have made a bad decision. So we're not infallible. Mm-hmm. What I would say though is that you could never criticize my motivation. I am a big shareholder, mm-hmm. and so I'm doing everything I can to make my shares, and therefore our shares, as valuable as possible. So it's never a case of, we've never had bonuses around here tied to production gains or tied to, our bonuses we have a very simple compensation scheme here. We have salary, bonus, and options. So options are very aligned with our shareholders, obviously. And bonuses only get paid if we have generated cash flow, period. And it's tied to the cash flow bonus, which I think is a bit unique. I mean, so I don't, just because I think I had a really good year, if the company didn't have a good year, then I'm not getting a bonus. And vice versa. I mean, and I think we're fortunate. 2021, we had a record year for cash flow. It was our single biggest year ever for cash flow in the history of Pine Cliff. In 2022, on forward strip, what prices look like right now, it looks like we could double what we did in 2021.
You eat your own cooking, like Warren Buffett would say.
Yeah. I think it's a good, for investors, I tell my own kids that when they're looking at investments. I said, it's by no means is it a guarantee. Just because somebody's got a lot of skin in the game, that's not a guarantee that it's going to be a successful investment. But I can tell you, it moves you a lot closer to the chances of it being a successful investment than someone who has nothing in the game. Because I just think the motivations aren't always aligned. You got people that are empire building. You got people that just want to be bigger to be bigger. The test we use here, and it goes even right down to whether we drill a well, is that tell me, guys, why it's going to make our shares more valuable by doing this action than it would before, whether it be drilling a well or doing an acquisition. We did an acquisition here in Q4 of 2021, our last deal that we just did. It was a $22 million acquisition. We did it without any debt and without any equity. And we just did it. So it was just with cash.
Awesome.
But does this make us stronger after the fact or not? And you got to look at a lot of variables. When you're buying legacy assets like we do, the liability is very much something you got to get control of. You got to understand it. And it's not something you should be terrified of. It's just, there is going to be at some point, these wells are closer to the end of their life than a brand new well that gets drilled. However, when you buy the right assets, these assets will continue to pay for decades, literally decades. And so that's a key part to the model. And we've, even in the leanest years, we still spent our money on abandonment reclamation for inactive wells. We're very proud of the fact that we have one of the highest ratios of active wells to total wells of anybody in the industry. So yeah, we have a lot of wells. We're looking after 6,000 net well bores, but we're close to 90% of those wellbores are active. And so we don't have that huge inactive liability that's staring it in the face. And again, when that goes to acquisitions, that's something we look at very closely.
One of your jobs as CEO of Pine Cliff is to be a capital allocator. When times are lean, natural gas is in the toilet. Did you ever think about repositioning the company more towards oil? It seemed like a safer bet, maybe? Yeah,
no, it's a good point. I 100% agree with you. I view my job, there's a certain amount of being the team captain and making sure everyone's doing what they need to get done. But I'm very fortunate. We got a team that doesn't need a lot of guidance. We don't have a lot of management. We have a bunch of guys and ladies that are doers. But capital allocation, I think, is the number. If there's one, if I had to pin it down to one thing at the CEO level, that's what it is. And so we're very fortunate. We were able to get a hold of, this is part of the acquisition we just did, the Bakisco oil field that we've been slowly adding positions in. It's proven to be a very good field for us. And that's in central Alberta. And so it's oil weighted. And there's gas along with the production, but it's predominantly oil. Now we're very fortunate that, oil has gone on quite a ride here recently. But even before this, those wells were paying back in less than a year. Mm-hmm. So really good use of capital. And, I had this conversation with an investor this morning. To me, free cash flow yield is the best metric to look at when looking at a company, because it takes in just about everything, mm-hmm. right? Because as long as it's apples to apples, as long as you're going to every company and saying, okay, I need to know every dollar you spent, period. And then how much do you have left over? Don't tell me just what your growth capital is. Don't tell me just, don't pick and choose. Tell me how much your bonuses are. Yeah. Tell me how much you're paying. What's your interest on your debt that you hold? Tell me exactly how much your maintenance capital is. Tell me what your abandonment reclamation. Take all of that out and then what's left. And I think that's where I think the Pine Cliff story is really going to resonate this year, is because our free cash flow yield is higher than anybody else out there. I haven't seen a higher free cash flow yield. Even the oil guys, even at these prices. Now then maybe I haven't seen the most recent stats, but we're somewhere around 45% free cash flow yield right now. Mm-hmm. That's a big number. Mm-hmm. And so, but that takes into consideration, for instance, our decline rate. Our low decline rate is built into the free cash flow yield, because in theory, the free cash flow yield should be whatever it keeps to keep your production flat. And then what do you have after that? And because we have such a low decline rate, we don't spend much. Our budget this year to stay flat is about 25 million, and that, again, I should point out that 25 million includes abandonment reclamation and maintenance costs. So it's all kind of baked into there. So when you ask a question about capital allocation on the oil versus gas, we our best locations right now are oil locations. Mm-hmm. So that's where the capital is getting allocated. So the Pecusco oil wells that we did in Q4 have come on very well. We're on May 4th. We're going to update the market as to how the last two wells, it was the first two wells that ever been drilled in the unit, horizontal technology coming back into the unit. And so we've been pretty excited about to see how those results are. So far, knock on wood, they've been pretty good, and we'll update the market on that in a few weeks. We do have gas wells up in the Edson area. We don't operate. So we don't control the pace of development. The one piece of the puzzle that I would like to add at some point would be some gas locations that we can control. And so that'll be, the nice thing is there's no urgency. If we do it in the next few years, that's great. You look at our Pecusco locations, and we got all our locations together, about 75 locations, which isn't a very big number. But we only drill like 5 wells a year. Even though we're 21,000 BOE a day, that will still keep us kind of roughly flat. So that's the benefit of having the kind of that legacy production that just doesn't need, just for listeners who may not know, the average in our industry is about 30% decline rate. So to have a single digit decline rate, really, there is no other public company that has our model, in Canada anyways. I'm not saying that's really good or really bad. That's just, we are unique.
Mm-hmm. It sounds like if the opportunity arises, you may position a little more towards oil to capitalize on.
In the short term, all our drilling this year will be oil weighted. With these kind of at $100 per barrel, it's tough to ignore those economics. Going forward, I think there's could change. Now, that being said, I don't want to make it sound like gas is a poor sister right now. We've got this weekend, which was, I was talking about this with our guys. It was amazing that it was warm here in Western Canada, but gas prices were $5.60 an MCF this weekend. But this has been now going probably close to 8 years since we've seen gas prices like this. We got the forward price for this summer is around $4.85, I think, as of this morning. Those are really high numbers from what we've been used to. And the storage, despite all that, storage is at its, well below the 5-year lows. So, we need to replace storage. Otherwise we're going to, if we have another winter like we just had, which was a pretty cold winter in Western Canada, we're going to have a gas issue, which is what we're seeing globally. That's what's happening in Europe. Their storage got really low, and that's even before the Russian invasion, which threatens those, 40% of their supply going into Europe.
Do you think the fear of peak demand is leading to the reality of peak supply in terms of natural gas and oil?
You know what? I think we're going to start to see the discussion about oil and gas get separated, bifurcated a little bit. I think it is, that for sure oil's not going anywhere for anytime real soon. It's 100 million barrels a day, globally. Even if it peaks sometime here soon, and I think it will eventually go down. I think we all kind of agree that there will be a transition. I think the debate really is what's the speed of that transition? What's a realistic speed of that transition? And I think that a lot of people were much more, they had bigger hopes for how quickly that transition could happen than what really can happen. So I think the gas, the EU, the European Union, came out right around Christmas time and made an announcement that the only way they're going to get to net zero emissions is with the use of natural gas and nuclear. And they got some pushback from environmentalists. But that's a practical, real answer. That is the only way they're going to do it. Natural gas isn't going away anytime soon. And I don't think oil is either, but I think natural gas has a longer life than even oil does, just because natural gas, because it has less carbon. It's an easier, right? A lot of people don't realize, that the United States, in 2016, natural gas is now the single biggest source of all power generation in the United States. That's a real, it surpassed coal. And so when people talk about electrification, and I get that, everyone wants to drive electric vehicles. That's great, but where's the power coming from? And so I think that's a key variable, is that, never mind the infrastructure that has to be the grid build out that has to happen to move to another level of electrification. It's also, where does the power come from? And we've seen, in Western Canada, it's great to have renewables and solar and wind and hydro, but they're just not always reliable at all. And so therefore you can't tell people in the middle of January, sorry, we don't have, the turbines aren't working and the solar panels aren't generating. They need heat. It's literally life or death. And we had times in Western Canada where 100% of the grid was natural gas this last winter. So you're always going to need that redundant power, and it's not efficient, and it means it's going to be higher cost power. We went from coal. The big shift that people don't realize in the last 3 years in Alberta is our coal to gas shift. We've gone all our power production, or not all, but we were at, I think, at peak around 80% of our power was coal production. We're going to be zero by the end of 2023. So natural gas has picked up most of that slack, not all of it. Solar and wind have grown. But again, Europe, the primary reason why they're so low on their natural gas storage, even before the invasion, was because wind wasn't blowing nearly as well as it historically had for the previous 2 years. So they used a lot more gas. And so they got to very dangerous low gas storage. If it would have been a colder winter, it would have been absolute crisis in Europe. Luckily, it wasn't a real cold winter, but even that, they still have, the highest gas prices in the world right now.
It's been a rough decade for natural gas, more or less. Prices have been tough, but they seem to be creeping up now. Do you think that's because of the lack of investment in drilling natural gas properties and whatnot?
Yes and no. I think some of it, yes, but we are growing our production in Western Canada. We're probably up about a BCF a day of growth. Yeah. Demand is growing faster than, I always tell people to watch storage. To me, the storage is and I do a quarterly newsletter or email out to our investors. So if any of your listeners are interested, just send me a note. Go to our Pinecliff website, and I'll put you on the distribution list. I was pointing out in my last one that, it is what's happening around natural gas. If I had to come back after being away for 2 weeks, the first thing I'd want to see is the storage numbers. Because to me, the storage numbers are the scoreboard between supply and demand. And storage right now is below 5-year levels in Western Canada, United States, and in Europe. So the 3 major natural gas storage hubs globally are all well below, which means demand has been bigger than supply. So you're right, supply has grown and people are drilling. I think there is a natural cap on how much drilling you're going to see on the natural gas. And it'll be interesting to see what's coming out because of the Russian invasion. We're seeing now people wanting more natural gas out of North America, which should have been the mantra for the last decade. But hey, that's done. Here we are today. I think energy security is now something that people are going to think about where they're getting their energy from. And so Canada can play a great role in that. I think the LNG is really going to be a game changer for Western Canada. We've never had the ability to send our gas anywhere else but the United States, which is an expensive process because we got to pay for the transportation. To be able to send it to the West Coast is going to be a huge advantage for the Western Canadian natural gas producers. And it's now not that far away anymore. Now we're talking about a couple of years. And that's, just to give the listeners a context, we make about 16 and a half BCF a day of gas in Western Canada. The first LNG facility is going to be about 2 BCF a day. There's a very high likelihood that they'll announce their second phase at some point here before it goes into production, which would take it to 4 BCF a day. I mean, that's 25% of all of our production, which previously was all going east, will now be able to go west. Yeah. And that's going to change things. The United States, if there was one thing and I was having a conversation with an investor in Boston who'd been away from the energy space for the last 6 years, which there's a lot of people that have been in that camp that are now coming back to the energy space because they're seeing the returns on the stock markets and they're saying, geez, I better go figure out where can I get some exposure in gas or oil or whatever they're looking for. And I was commenting that 6 years ago, the United States exported 0 LNG. 6 years ago. That's how brief it is. And they're now the single biggest LNG exporter in the world. They're over 13 BCF a day. And they're exporting another 6 to 7 BCF a day by pipeline to the exports to the Mexico. So they're up to 20 BCF a day of exports that didn't exist previously. And they make about 91 BCF a day. So they're about 20% of their production is now leaving the shores of North America, which is good for everybody. But I think Canada, I am passionate about how big a role Canada can play. The LNG coming out of Kitimat, which is the LNG Canada, will be the cleanest LNG in the world because it's a hydropower. It's in Kitimat, so they don't have near the energy costs of Gulf of Mexico when they have to liquefy the natural gas. And you're 10 to 14 days less travel time on the ocean to get to the Asian markets. So you're saving a whole bunch of money on emissions and on costs, as opposed to sending it out of the Gulf of Mexico. So it is, I think it's going to be a really exciting time to be a natural gas producer for the next decade.
In layman's terms, the last decade, prices have been low because there's been oversupply and not enough demand, but it seems like things are picking up. Demand is increasing. Maybe supply has fallen off a little bit, but as prices rise, people start making money. A lot of people rush back into drilling natural gas, investing in the sector. Do you worry that things are just going to fall right back down to rock bottom prices?
Well, the one thing that I think that is a concern. I think we've seen it before. The expansion, TC Energy has spent or will be spending, they're in the tail end of finishing up about $7 to $9 billion on expansion of the system over the last few years. So that's a positive. The other thing is we've seen a lot of consolidation in Western Canada, unlike the US. And so there isn't many private companies. Where they're seeing most of the growth in production in the United States right now is from the privates, not the publics.
Guys, yeah.
And it's because the public markets are demanding a return of capital from their investments, which is very healthy. Our industry's done a horrible job of returning capital to shareholders. You look at the rate of return from investing in energy over the last couple of decades, it's not impressive. There's individual cases where, like I said, a Bonterra that I just mentioned would have been a great investment for the last couple of decades. But generally, the industry has everything it did in cash flow went back into the ground. It was all about growth. All the CEOs were rewarded for growth. The market was rewarding, the companies for growth. That's changed. Now, is that going to change in the future? Then, you get whatever you ask for. Right now, they're asking for return of capital. Yeah. They're asking people to return dividends, share buybacks, which is, I think, a very healthy thing for our industry. It will, by virtue of the fact, if I'm giving back 40% of all my cash flow or 50 or whatever it is, that means I'm not spending it drilling in the ground, and therefore supply will be naturally mitigated and held back from. So I think there is that. Then there's a practical consideration that because the industry's gone through such a tough time, and I know some of the speakers that you've had on your podcast have talked about this, that it's not easy to get crews. There is if I wanted tomorrow to go out and just drill a whole bunch of wells, and again, that's not our model, but it's for some of the bigger companies, there isn't a real issue in trying to get people. You can probably find the rigs, but you're not going to find the crews and the frac crews so I think and there's an inflationary piece that's now coming in. So now it's getting more expensive because of the supply chain issues the world's having and the fact that you're going to have to, there's a lot of natural kind of resistance, I think, to seeing supply get out of control again. And go back to the consolidation. Tourmaline, who I think is an extremely well-run company, and I know you had a guest from Tourmaline. I found that quite interesting to listen to. Yes, they've taken out 5 or 6 major private companies in the last 2 years. Then you had C&Q which is Canadian Natural Resources, another very well-run company, took out Storm and Painted Pony. I am much more comfortable that CNRL and Tourmaline are going to be careful on how hard they hit the accelerator pedal than I would have been with all these other companies out there. Just because they all would have had their own agendas. They all would have had debt to repay, or they would have had private equity groups that they had to answer to. I think we're going to have a much more controlled response on the supply side because we are so tightly held. And for me, that's healthy because we were never one of those companies. We never spent more than our cash flow. But others did. And so we unfortunately suffered the consequences of it. But I think people are going to be much smarter this time. And you're seeing, the return of capital that's going to be generated by our industry and given back to shareholders in 2022 is going to be mind boggling. Mm-hmm. Like the numbers really, it's, we can point to our cash flow and we're very proud of it. And that, our free cash flow yield is 40 to 50%, which is just a crazy high number, but we're not the only ones that are generating a lot of cash flow. Just about everybody is. The slight difference we have is that we got rid of our banks 2.5 years ago, or they got rid of us, whichever way you want to put it, but we no longer have bank debt to be dealing with. This be an advice I'd give out to anybody who's starting up or thinking of starting a company out there. All of my debt is currently held by my 3 biggest shareholders. I can tell you the dynamic of that is entirely different than when you're dealing with the banks.
A bureaucrat.
Yes. Yeah. And they get their orders from their head office, and every 6 months you're always kind of not sure what their appetite's going to be for investing in the energy sector. So I'm very fortunate. Pinecliff's a very unique story because we've got a very high retail ownership, including myself and George and a gentleman by the name of Bob Disbrow, and a whole bunch of other individuals own a lot of stock. And then we have AIMCO, which is the Alberta Investment Management Company that owns over 10%. So we have a unusual situation where we've got a lot of retail, and then I think they're the biggest single institutional shareholder in Western Canada, is also a big shareholder. So it's a kind of a unique shareholder base. But I think as we head into 22, like I said, we did about 60 million in cash flow last year in 2021. And on current strip prices, we're looking to do like 130, 140 million this year.
It's incredible.
It is.
As a capital allocator, what do you think is the best use of that extra cash? Is it dividends? Is it share buybacks? Is it drilling?
Well, I think it's a little bit of everything. I think we probably won't do share buybacks immediately. And I say that not because I'm an opponent of using the share buybacks. I think I don't know if it was Warren Buffett, but I remember reading once it's a tool, but just like a sledgehammer, you don't hang your pictures on your walls with a sledgehammer. It's a tool that should be used at the appropriate time. And for us, because we're fairly tightly held, I fear that if I'm buying back shares, I'm going to remove even more of the float. And therefore it'll be tougher for people, especially institutions, to invest in us. And so I want to keep as much liquidity in the stock as possible, because I think as we go to a dividend, and we're announcing our very first dividend on May 4th, that we're going to get a much wider audience of investors. There's a lot of investors out there, a lot of funds, a lot of indexes, a lot of groups, the family offices, high net worth retail, registered accounts that they really want dividends, especially in this time of when interest rates are so low. Even though they're rising, they're still very low. So if we can put out a really strong yield, a very sustainable yield, I think we're going to get a lot of investors that we never would have got before. And so because of that, I want to keep the liquidity open. So I don't think we're going to be buying back shares anytime soon. Dividends, definitely. I think dividends are it's my introductory comments were, we always wanted to build a dividend company. And now it's very satisfying, and it's very exciting that we're going to announce our first dividend in 5 weeks from now. And that is, it's been 10 years in the making. We'll be an overnight success story of 10 years in the making. But we're very comfortable that we can put on it will be a real dividend, in the sense that I'm not looking just to put out, sometimes you just see a 1% type yield, because that allows the dividend investors to own them. But no, we want something that's going to turn heads. I want people saying, wow, that's a pretty impressive yield. So then who maybe never even heard of Pinecliff, most of them probably will not have heard of Pinecliff, will come to the story and say, wow, these guys have like no debt, and they've got, huge insider ownership. And the question will not be, will they cut this dividend, but when will they raise it? Mm-hmm. I mean, so I think that'll be a part of it. Our drilling program will be, we've announced the drill program for 2022 at these prices. It's quite possible we raise it a little bit, but we might raise it, maybe add 2 wells. So that, net to us, it might be another 5 million. We're not a geology growth drilling story, and we never will be. But what we are is a cash flow manufacturing story. Like that low decline really puts you into a different category. Like I want to compete with REITs and utilities, and we can generate the same kind of free cash flow yield that you'd think of in the more traditional sense. And I think the gas story is from an ESG standpoint, it's a pretty good story. The ESG, the gas to coal shift that's happening around the world, that reduces emissions by 60%. And so I think gas is part of the solution. I think because we don't drill much, there is very little flaring. We don't use a bunch of frack water. There's a bunch of things that kind of go with the story that I think make us pretty attractive to a lot of investors. And I think the dividend is going to open a lot of doors for us.
That's just good business. But do you think there's also perception that energy companies should pay dividend just because of the nature of the commodity markets and how up and down they are?
It's tough. You're right. I think, and that goes back to my very first comments, low decline is the magic sauce, if you will. I mean, Bonterra, and I hate to keep coming back to them. It's just, it's a model that we have followed very closely, paid a very good dividend for decades. And most people would say you can't pay a dividend on it, or not most people. Some people would say you can't pay a dividend on a resource company because of the commodity price is just too volatile. And I would say, well, they sure did a pretty good job for a couple of decades. And why is that? Because they didn't have a really big decline rate that they had to deal with. The problem you run into if you've got a big decline rate and then commodity prices swing on you is that, okay, now you're faced with do we quit drilling and then our production drops, and therefore, the production is what's feeding the dividend. So then your dividend's just not sustainable. I think the key that as an investor, I would encourage everyone to look at is, as these dividends come out, is really look into the free cash flow yield, and on the stock, look at how sustainable the dividend. And we're not the only one. Like I think groups like Tourmaline have a very sustainable dividend. And, they're using, what I'm intrigued by is kind of what's the optimal dividend strategy? Like, is it a special dividend? Is it a structured formula dividend, which is a lot of the U.S. Companies have gone to? We're lucky because we don't, our debt, we have $30 million due to AIMCO. Well, it's not due for another 2 years. We'll pay that off this summer. So it'll be gone before September. And so we don't have the debt repayment as part of our capital allocation structure. That's just going to happen. So it is going to be interesting to see which is kind of the best. This is new to our industry, right? There hasn't been a lot of dividends paid outside of the producers. I mean, there's been the infrastructure, the midstream companies have, but what is the best model? Is it a special dividend like Tourmaline's using, or is it a more structured like Tamarack is using, or, I think everyone's going to be looking to see what is the best structure. What I like though is that just about everybody's going to the dividend model. There's only a few exceptions that have chosen not to. And a lot of times because they're still paying down debt, and I get that. Or they've used in share buybacks. If you did a lot of acquisitions like a Tourmaline, then you might have a lot of float out there that you're trying to clean up because it was private equity owned, and they have life to those funds, so they need to sell it. So you may want to be helping clean that up, and that allows your stock to leg back up again. So it's I think hopefully the one thing I would make a comment is I've been around this industry for 30 years. The CEOs are much more sophisticated these days on cost of capital than they ever were before. I mean, I think I look back on the early years, and people just had equity and and barely any debt. I mean, they had bank debt, lines of credit, but they just hit the equity button every time they needed, and they always to go buy something. I think people are much more astute. I think the management teams now understand cost of capital. They understand what it means to do, like what's a royalty cost you to what's a convertible, what's a term debt. Yes, it has a higher premium, but there's other factors versus bank debt. I think there's a lot of options out there. And I think I think we're all a lot more sophisticated when it comes to capital allocation than we ever were before.
It's not just grow and sell the company and move on.
No. I think that the trust era was very much like that, where it was just grow and sell into the trust and start back up again. I think it's not as easy to start up again. You're seeing companies that, like, now it used to be that if you might go down to the petroleum club and have a seminar and gather $5 million together among several people, and that would be enough to go out and start something. Pretty tough to do that now. I think we're 21,000 BOE a day, and we would be considered small cap, right? Like, 21,000 used to be a good size intermediate. Mm-hmm. And there's a lot less companies out there. And unfortunately, depending how you view it from an investor standpoint, I think we're going to see less. I think there's going to be more consolidation in 2022. You're going to see these, when you go to your question about capital allocation, some of these companies are generating billions and billions of dollars of free cash flow. Mm-hmm. What are they going to do with it? Yeah. They'll do dividends, they'll do share buybacks, but they're still going to be left with a lot. So I think you're going to look at, we just saw the Leucrotta transaction yesterday. I think we're going to see more of those types of transactions. And so, I get asked the question whether or not are we a target? And I say I don't have a golden parachute on my back. I mean, if somebody comes and makes a good offer for the shares, myself and my family, we own about 10 million shares. I mean, if it's a good offer, I'm willing to listen. We've never built it to be sold, But I recognize like we have, $380 million of tax pools. We have the lowest decline rate in the industry. We're generating $140 million this year, whatever the number is going to be after all said and done. I mean, that will be attractive to a lot of people, but I also think it's going to be pretty attractive as an investor. Mm-hmm. So the nice thing about it is because we're so tightly held, I mean, our top 4 shareholders own about 35% of the stock. So no one's going to be able to come in and buy 5% or 7% of the stock and then tell us, here's what we think guys should do. Mm-hmm. I think we can, chart our own destiny. Now, if that means merging into another entity, then I'm all ears. We may be the consolidator. There's a lot of private companies out there that we know that have similar assets to us. We're the one that is public, so we can give them liquidity. So we may end up being, who knows a year from now what the size of Pine Cliff is.
In a hot market, though, in terms of doing good deals, would it be harder to buy companies if people are asking for 10 times cash flow or something?
It is, although, again, it was right before this last run-up. But the asset that we did we closed on December 31st, which wasn't very long ago, we bought that at 1.6 times cash flow.
Which is a good deal.
And it turns out that it's probably going to be less than 1 times cash flow now because commodity prices moved up. So yes, for an asset acquisition, those are very impressive metrics. The thing about, because the investors, the generalist investors haven't come back to our sector yet, everybody's trading at pretty low historic multiples. So if you're trading at 3 times cash flow, it's pretty tough to justify going out and paying 4 times cash flow for an asset. You'd have to make a pitch that the upside, the drilling inventory is much, but it's dilutive to you, at the start, right? The initial calculation is dilutive. So I think that will keep a bit of a cap on what assets will go for. I mean, there's several processes underway right now. There'll be more to come. I think some of these, when we've seen the massive consolidation, at some point capital allocation, you look at your asset base and go, we have 10,000 locations. Why we're getting no value for that last 2,000 locations. So why don't we get rid of that and let somebody else take those who will get value for them? And maybe we'll take, you can take back shares, or there's different ways to do that type of transaction. But I think we will start to see some of that. And like I said, we don't need to add anything. At some time in the next few years, I will make an effort to add, especially natural gas locations that we can control. And we look at the Deep Basin. We're not going to be a Montney player or a Duvernay player, because I think that's a much bigger player's game. But we like the stack zones in the Deep Basin and around our Edson area. We just would prefer that we're the ones that are the operator, because it allows that you can decelerate or accelerate the play to your own individual capital plans. When you're a non-operated partner, you're kind of at the whim of your partner. And we've been very fortunate. We've had good partners in the area. And we have good communication with them. So we got a pretty good sight line into what's coming down from a budget perspective, but we still would prefer to operate.
In February, roughly 2020, Pine Cliff stock was about 10 cents. Now it trades about $1. Do you know anyone who loaded up at about 10 cents and maybe is Calgary's newest billionaire or something?
I know some people, it was tough. And I've had this conversation with my wife because I bought shares all along. I bought some at that level. I wish obviously that I should have backed up the truck and put another mortgage on the house. But it was tough, as we all know. You think back, everything was falling like knives. And it was, I know some people who did, who bought in around those levels, and now obviously have done unbelievably well. And so good for them to have the gumption to go against the nice thing is we never sold any shares. Yeah. We've been very fortunate. I remember Bob Disbro, who's my biggest single shareholder, and he's been a incredible supporter, buying all through those low prices. I don't know how much he got at the very lowest prices, but he would phone and we'd talk through it, and he'd say, "Oh, no, I'm going to go buy some more." And he owns 40 million shares of us, or somewhere in that range. So he's done very well. Mm-hmm. And George and I were buyers. Did I back up the truck and buy as much as possible? No. And it's, in hindsight, obviously.
Do you know anyone who did?
Not in any really large way. I know people who did buy at those. I got good friends, good family that bought at those levels and have done very well. So it's great getting the phone calls and the emails and the texts now. Them having the courage to invest in our company has changed their lives. And I love those stories. And it sounds a little bit sentimental, but it's not when people tell you what it's meant to them, you know, that they've paid off mortgages, that they've been able to send their kids through university. Then we've got, one shareholder who's got, I think his license plate is TOUPNE. So, cause Tourmaline and Pinecliff were the reason that he was able to buy a new vehicle. And like, it's nice. We went through some tough years. 2015 to 2020 that was a tough time. You know, our stock price was at $2 back in 2014. So now we're back over $1, and that feels good, but you're right. It's a long way from 10 cents.
What I wonder is whether it's dumb luck or educated bets, but
in hindsight, and it's always hindsight, we knew we were never going to go under. I mean, even in the darkest days, just because of who our shareholders were, that if we needed to borrow money from Aimco or Bob Disbrow or George Fink or myself or whoever, anyone else who had big shareholding positions, we would have made it through. What we didn't know at the time was how long and how difficult the road ahead was going to be. And so this was at like I say, at the beginning of COVID, and, it seems like everything was hitting us all at once. And so it was, it's a challenge. It's interesting now that the narrative has changed around natural gas, around energy generally, about how important it is to people's lives. And I think, if there's any, and it's not a silver lining because of the absolute tragedy with the invasion of Ukraine, but it is making people rethink energy, and it's making people really think about, okay, in the long run, who do we want because energy is life. Sounds like a cliche, but that's reality. We all, I've spent a lot of time in China. I know the issues that they're dealing with the urbanization. Cities of 20 and 25 million people in a city use a lot of energy. And so I think a lot of the countries, a lot of the governments are now thinking about, how do we going forward? How do we reduce our emissions? We want to help contribute to the climate change issues, but how do we at the same time still keep our economy moving? And so I feel for the government leaders because these are difficult decisions, and they're top of their mind is, how do I get reelected? Yeah. And these are unfortunately some difficult decisions that are going to upset people. If you want to really move rapidly off of hydrocarbons, well, then you're going to have some pretty imposing taxes put on carbon. And that's going to have a lot of impact on people's, on the gasoline that they pay at the pumps or their energy in their homes. And those hit the pocketbook, unfortunately, among everybody. So they hit the lower income even harder because it makes up a higher portion of their disposable income. So these are difficult issues. What I like is that natural gas, because of the less carbon than coal and oil, I think is going to play a really significant role. And you're seeing it being, warmly accepted around the world in India and China. And, you just announced last week where Germany is now going to have 2 LNG import terminals being built. The U.S. has announced that they're going to increase their export capacity, which is great for all North American natural gas producers. I think Canada is finally going to play a role, and we should be proud of that. So it's going to be an interesting decade ahead of us.
It seems like it's so reactionary, energy policy and governments and all that. Do you know anywhere that isn't reactionary, that seems to have a steady hand through the last?
Well, I'm not going to, China is,
done it right.
Yeah. I don't know if there's any, what's the old cliche that democracy is, it's not the best, but it's the best of the alternatives. In China, they have made massive moves because they've had to. I don't think anyone who's ever traveled there, anyone will understand, just the massive macro issues that they have to deal with. I had dinner with the associate mayor of Shanghai. This would have been like 2006, roughly, maybe 2004. And he had 1.3 million people move into a city the previous year. 1.3 million. That's all of Calgary just showing up at Toronto one year and saying, okay, deal with us. We need schools. We need places to live. We need jobs. We need hospitals. It's like the macro impact of what they're doing. And so they've made huge, the Three Gorges Dam, the pipelines that they've had to build, the LNG facilities. China is now the single biggest importer of LNG in the world. Unfortunately, some of those decisions are a little more difficult to make in our world. I still would take that over a regime where we don't have the democracy, the right to vote, the right to elect our officials. But unfortunately, it makes them short-sighted because they're always wondering, how do I get reelected? And the difficult decisions may not be popular ones, but they're probably the right ones. And I don't know of any really great examples. Germany was seen to be the leader of taking the lead on the wind and solar and moving alternative energy. And now they're in a really difficult spot right now. And, with the highest power prices in the world, which is crippling to an economy because all your manufacturing moves outside your borders, and that's a tax base that you can't afford to lose. So it is, I don't know. It'll be interesting to see here in Canada how we balance it. We want to be part of the solution. We want to help the Ukraine. We want to help Europe, which means energy. That's how we can help them. But not all of our policies are geared towards increasing our production in Canada.
Like we were saying, capital allocation is probably your number one job. In your opinion, who's the best capital allocator that you've come across in energy or in general?
Well, that's a great question. I have a lot of respect for I mentioned both C&Q and Tourmaline.
Murray Edwards.
Yeah. Murray Edwards and Mike Rose, they are both, and I know Mike a bit better than I've met Murray. I wouldn't say I know him. Mike and I do know Mike. They've done a tremendous job. I think they've been very opportunistic. There was, CNRL went 18 years and they never bought a public company. And then they bought Painted Pony and they bought Storm in fairly rapid succession. And to me, that was a really strong indication as an investor that owning natural gas was probably not a bad thing to do. And the fact that valuations were cheap enough in the public market that they viewed that as opposed to buying it in the private side, which is what they historically had done for a long period of time. So I think that to me was quite telling. And I thought a really good use of capital. I think and I think the transactions that Mike did for Tourmaline around, on Saturn and Modern and Jupiter and Black Swan. And those are, the timing was impeccable. So the fact that he made sure that he had the ability and the capital available to do those transactions at a time when, now the looking back on those transactions, they were just done at phenomenal purchase prices. So, those are two pretty shining examples of people that have been very astute, longer term, investors and big, again, it goes back to the point you made earlier, and they own a lot of skin in the game on both sides of that, right? So I think it drives the right behaviors. The one thing about owning a lot of stock is it takes you away from worrying too much about the short term. I had this discussion with an investor yesterday, is that, I'm personally not gonna, if we were to announce a really big dividend tomorrow, that probably would give our stock a pop and we'd feel really, but if that's, I really don't believe that that's necessarily the best thing for our company in the long term. And all our decisions are around the long term, because when you own stock, that's the way you should look at it. And so I'm not looking to sell stock tomorrow. And so therefore I'm not worried about whether the stock pops or goes up or down tomorrow. I'm thinking in the next 5-10 years, this will be the legacy that I leave behind for my family. And so how do I build up that to the highest level I can? And I think the shareholders who come on side with us understand that. They understand my motivations, and they're quite happy that I'd be thinking that way. And so I really spend a lot of time now trying to talk to family offices, high net worth retail investors, because they have a much longer perspective. A lot of the institutions have a very short term perspective. They have to, and that's just by design of that industry, right? It's all about quarterly returns, and it's about what have you done for me lately and what catalysts are you looking for? We're not really a catalyst story. We're kind of Pine Cliff is moving into a maturity that allows us to be a manufacturer natural gas and provide a really nice, healthy dividend and return of capital. So it's quite, like I say, it's quite exciting. I mean, it's been, we've waited a lot of years for this day.
Murray Edwards would be energy specific in the sense they're good capital allocators. You meet a lot of people, a lot of investors, family offices. Do you meet anyone that stands out in terms of capital allocation across a variety of industries that seems to be able to invest everywhere, like maybe Jim Pattison or someone like that?
Yeah. You know, I know of Jim Pattison, especially when I was living in British Columbia. We see it, I mean, in our own case, I mean, he's resource weighted, but I mean, Bob Disbrow, our biggest shareholder, has done phenomenally well, but it's been, you know, I think most of it's been in the resource side. So he's done a really good job on that. You meet different groups. I mean, Dean's Knight is a group out of Vancouver that I think have done, again, a bit more resource focused. That's the groups I tend to meet. So I don't spend a lot of time. I don't get a chance to meet. Hopefully that's going to change when we move to a dividend. But, you know, who do look at many industries. When I started this 10 years ago, the number of resource funds that were out there was quite plentiful. And so, you know, you'd go to Toronto or Montreal or Vancouver and you'd have a full day of meetings. Mm-hmm. Now it's a smaller group. You had Eric Nuttall on. I mean, that's the 9 Point. And you got Canoe here in Calgary, and it starts to get pretty thin pretty quick. I think what we're going to see going forward, and I'm already starting to see it, is that the generalist investors are starting to look back into energy. And I think you're going to see more. I mean, maybe you'll see some new energy funds arise, and, you know, you'll see the anti-inflation funds or ETFs. Well, that means that they're going to want to own commodities. So that, I mean, that's what, if you're worried about inflation, then commodities and resources are a pretty good place to put your money. So I think we are heading into a new era. It's been a tough time for the last few years for being a resource company, but the companies that have survived are very strong, and they're getting much stronger by the day because of their cash flows, and they're getting their balance sheets in order. Like I said, we were forced to get our balance sheet in order earlier than others, but everybody's getting their balance sheet in order. By the end of 2022, there is going to be a lot of really strong resource companies.
Mm-hmm. Do you think it's sustainable, or are we just in another cycle?
I think the natural gas, my own view is that the base for natural gas prices has risen. I think that the demand, the LNG, the power, people are talking about hydrogen, and that's great, but like currently 95% of all hydrogen is made from natural gas. So on the natural gas side, I'm very comfortable that the band that we're going to trade in has moved up. So I think we're not going to spend a lot of time with gas prices under $3. You know, I'm not saying we won't have some days that'll happen. I just don't think we're going to spend as much as we did, as historically did in the past. And so that gives me a lot of comfort, because at those, even at that $2.50, $3 level, we can have a very sustainable dividend. And so that's where the sensitivity analysis we're doing right now on what we should set our dividend at. The oil side, I think it has, but it's such a large piece of the global energy pie right now that it may top out. We may have finally a peak oil use, but it's still going to be a peak at a very high level. And I think it's going to take a long time for that to move down. In our presentation, we show a picture where we've got, 10 years ago, 80% of all the energy needs in the world were from hydrocarbons. And today, 80% of all the energy needs are from hydrocarbons. Yeah. Despite the massive growth we've had in solar and wind and geothermal and all the other alternatives, the pie has just gotten that much bigger, and the pie is not going to get smaller. Like when I look at the EIA and their forecasts on energy use going forward, I really struggle to believe. I mean, a lot of times they have it plateauing. Anyone who's ever traveled to Asia knows it's not plateauing. I mean, the energy demand is just going to rise, and it's not what's going on in our backyard. It's what's going on around the world. And China and India are going to lead that surge, and they will continue to demand a lot of oil. And it's as they move people from poverty to middle class, it just goes up. And that's very healthy for our world. Yeah. Because the people dying in poverty there's no excuse for that. We have too much resources around the world to be able to allow that to happen. But it does give us more challenges, because we're going to have a much higher energy population, still rising. And so we're heading into a period of time where we're going to have a lot of capital allocation being determined around the world as to how do we allow these, how do we all kind of manage to survive? I like the analogy of the swimming pool. We're all in the same swimming pool. You can't have rules in one corner of the swimming pool and another. I mean, it doesn't matter. We're all in the same pool. So the fact that China is bringing on over 100 coal plants in next year, that's not a good thing for our swimming pool. Like we need to help them get off of coal. That's and I think that's where natural gas could play a really big role.
$50 natural gas prices or something like that may not be unrealistic.
Well, that's what they are. They've been in Europe.
Yeah.
I think my own view is that band is probably, like I say, if the floor is raised, I think there is a certain cap in North America. I don't know what that is, but we're seeing $5 or close to $6 gas right now. So you got to think that band is somewhere 3 to 6 or 7. I think once you get above that, then you might start running into some of the supply issues you're asking before, but maybe not once LNG's on. Once in 2 years from now, maybe that's going to be the prices will be in that $6-7, which is still, the world still goes around. It'll still make sense to liquefy that gas and send it to other parts of the world, which are quite happy to pay $12-13, right? Like, I mean, that's a reasonable. They're paying $30-35 right now. But I mean, so if you were to bring that back down, then natural gas becomes a much more, so I think we'll find that happy medium. And for producers in Western Canada that have been living with sub $3 gas for a long period of time, they've already done, in most cases, I would imagine, I can only speak for ourselves, but like we've done all the heavy lifting to remove any excess, spending and to run really lean. And so it just drops to the bottom line. If you raise the commodity prices, our free cash flow just goes way up. So it is, and that's what we're seeing right now. I mean, to have free cash flow yields in 40-50% level is like, it's just unheard of. And I like going back to that, I still believe that free cash flow yield is such a great way to compare across industries, right? Like, just tell me all of the costs that go into making your product and tell me how much at the end of the day you have left over to give to shareholders.
Charlie Munger would criticize EBITDA earnings, or he doesn't like that.
Yep.
He much prefers something like cash because it's, like you say, a lot more real.
On my bedside right now is the Intelligent Investor, and this is my second time through it. But that, you're right. It goes the cash flow. We've always bought assets on cash flow. We actually, in our earnings, we now have earnings, but we didn't have earnings for several years there. But the business was still a successful business without earnings. It was because, so if I'm happy to be beside Charlie on this one. Cash flow, I think, is the key metric, and the free cash flow. It's one thing to say, look at how much cash flow we generate. Yeah, but if you have to spend 40% of all that cash flow to get back into the ground just to stay flat, or to constantly improve your manufacturing facility, whatever it is, then I don't want to hear that number. I want to hear the number. What's the sustainable number how much is left over that we actually could return to shareholders? You may choose not to. You may do acquisitions. I think there's going to be still some acquisition opportunities for us and in some businesses. Paying down debt is, the people don't realize that when you're paying down debt, you're increasing your ownership in the business, because quite often we don't think that way. But if the business is worth whatever its enterprise value, which is the equity and the debt, if you remove the debt, well, then the entire business hasn't changed, and yet the equity owns more. So I think, it's like paying down your mortgage on your house. Yeah. So it is, I think in our energy sector right now, investors are getting their growth, their equity ownership per share is growing rapidly every day, because this cash is, as long as people aren't wasting the cash, and I don't think they are. I think we're seeing, I think, very astute capital allocation. Does that change, to your question? Do we at some point? I don't know. It feels like that it's got traction, and a lot of that's driven by the capital will flow, I think, to the people that are good capital allocators. Yeah. And so therefore there's a natural tendency to follow suit. And I think we're all kind of on that same page, and we weren't. A lot of the industry was out drilling just to grow. You had executive teams that's what they were built for. I mean, you're seeing now executive teams that have a much more a longer term view on their business, and a lot of them are big shareholders. So there's a reason for that. But I mean, in the olden days, I always say you give money to a driller. What do you expect them to do? They're going to go drill, right? That's right. Yeah. It's in their nature. So, it's the old, scorpion, analogy. But it's exciting time. I mean, I think for our investors coming in, especially newer investors that maybe haven't been around the before, they may look at this and, is it different this time? And I mean, the scariest words to mention, to utter in investment world, but it is, it sure feels like there is a discipline that wasn't there before. I don't know. How do you view it? How you see it?
Well, I may not be qualified to commentate on the history of the energy industry, but it seems like people that are around probably are around for a reason. I mean, 40% free cash flow yield is hard to argue with at this point.
We stick out a lot. And I just, on that metric, I think people don't, for Pinecliff, and I don't want this to become a Pinecliff commercial, but I think when we go to the dividend, it's going to attract a lot of attention to our name, because it'll be like, how can a company of this size be paying out this kind of dividend? Yeah. And I think that's when hopefully they'll go through the numbers and go, wow, this is a pretty impressive little story here that we're only a $400 million type enterprise value company, but to be generating that kind of cash flow off of that size of entity is impressive. But it's not been easy. We've had very fortunate, almost no turnover here in our head office or in the field. And I've options. We grant options out to every single employee. So they're all, feeling the tailwinds of what's happening right now. And it's good. I'm very, very proud. It makes me, I get sentimental about it, because there's some people that have stuck with us through some really tough times. And it's fantastic that they're getting to see the upside of this. And that goes to the investors too. So many of the investors I have, as you can see here, I don't have an assistant or a secretary. If an investor calls, they're going to get me. And, so I've got to know my investors. And then I love hearing the stories of, they call almost apologetic when they need to sell shares, because, I tell them, look, I've got, thanks for showing the support that you did and when we needed it. And don't feel bad that you're now taking, to do some great things with the capital that you've gained. That's why you invest. So
I read a lot of Berkshire reports and whatnot. Mm-hmm. That's straight out of Berkshire.
Yeah.
That's what Warren Buffett would do.
I read his reports. I'm a shareholder in Berkshire. Cool. So I read, I haven't got this year's report hasn't been mailed to me yet, but I know it's out. But yeah, on your way out, you may see them. I've got a whole stack of them out on the bookshelf for everybody to read in my office. Those are just basic fundamentals that I believe in. I really, and I think the value investor, I think there's still opportunities. I think there's good stock pickers, I think, are still going to do well. I'm not convinced. I understand why people use the simplicity of ETFs. I'm not convinced of the pure efficiency of the market. I think Pinecliff's a perfect example. You look at, well, how can you have a 43% yield? Well, it's because we're smaller, and because therefore not enough people know who we are. I just did 2 days of marketing. First marketing trip I've done in 2 years since pre-COVID. And I was in Toronto and Montreal, and we had very good take up. Very good. It's like, wow, these numbers are impressive. So that clearly they hadn't been focusing on it, right? It need to be brought to their attention. So that to me shows that there is an inefficiency in the market. If I would have went to every meeting and they said, yeah, we already know this story, then I'd go, okay, well then, it's much more efficient than I thought, but that's not the case. So it's up to me to get out and tell the story. May 4th is a big day. That'll be the day that we announce our dividend. It's the same day that we announce our Q1 numbers, which is going to be a very good quarter, because we've got that acquisition that wasn't in Q4, it was part of Q1. We'll give an update on our Pekisco wells, which we're very happy with. And then I got to go out and meet some new investors. And so that's, your timing of this podcast was fantastic. Thanks for helping me, get the story out there, because it is, that's part of the capital allocations, a big part of my job. The other part of my job is helping try to get the story out to the right investors. And, we've done a good job, I think, over the last few years. We've got a really loyal shareholder base. I think they're all pretty happy and excited to be starting to get checks sent in the mail to them, in 2022. We'll still look at acquisitions. That's how we got to be 21,000. You know, we did it through acquisitions, not so much organically. So we'll see what's out there for opportunities. It's, I think we're going to see some good assets. I know we're going to see some good assets. Whether or not we're successful in getting them, that's, you never know. But we've been, we're always very proud of the discipline we've shown on the acquisitions too. We're not going to, you're not going to see us go in and do if we buy an asset, it's not going to be at a bid level that is going to surprise anybody. Every acquisition we've done has kind of been in the lower end, but it's allowed us to, if you got cash flow, it allows you to move very fast and not have to be subject to financing. And I think that creates opportunities.
Well, that's an hour.
Wow.
I won't take
that went fast.
Time, but like you were saying, oil and gas is a commodity business. Price goes up, price goes down, but some companies seem to do better than others. Your company, Pinecliff, Tourmaline, CNRL. What to you makes a good business in the commodity space? Is it execution? Is it discipline? Is it good geology? What makes certain energy companies stand out?
It's interesting. I think it depends a lot on the model. Like Pinecliff, I'm happy to be included. I'm hoping that our capital allocation skills are anywhere close to the allocation skills of some of the individuals you mentioned. But our assets are very, very different. So the good rock, I understand why people like good rock. And that is very important if you're doing a lot of drilling, obviously. And what is your inventory and what is your reserve life index? And there's all these different metrics you can look at. Pinecliff's a different creature. I mean, I'm not saying it's better or worse. It's just different. And so we really don't have another comparable in the public market that is doing what we're doing, which is why we have, our decline rate. There's nobody else out there, I don't think, with a single digit decline rate. Definitely not as low as ours. I think from our perspective, the capital allocation is a key part. I think that's going forward. That's what I focus on is, we're generating a lot of cash flow right now. So what is the best for our shareholders? What is the best thing for us? Mm-hmm. And how much of that is given back? How much of it maybe is doing another acquisition? How much of it is paying down our debt? Unfortunately, we're going to have, we may be the first Canadian oil and gas company, domestic oil and gas company anyways, to be debt free. We could be debt free this summer. So that's a bit unheard of. Now, is that optimal for a balance sheet? There's an argument to be made it isn't. That if you can get debt at 5 or 6%, and if you can drill wells that are at 100% IRR, why wouldn't you use it? Well, so I understand that, but I think for us, the sustainability of the model, if we don't have any debt, that means we also don't have any interest, which just gives us more cash flow, which again makes it more sustainable. I think the two things that you touched on this with your question about the dividend in the oil and gas industry, is that high declines can get you in trouble if you've got a dividend. And the other thing is not just the decline profile, but also on your ability to, I guess from your asset perspective, do you need to keep drilling to replace that decline? And I think for us, having the really low debt kind of removes that last fear factor. The debt is the one thing that's gotten people in trouble, especially combined with a higher decline rate, is the debt. Is that if you look at the companies that didn't make it, that had to sell or went bankrupt, it was because their debt levels weren't manageable. So it's kind of it's a long-winded way to say that we're going to have to think about it a lot, going forward. I think there's a role for our model in the marketplace. I guess that's the bottom line, is I think that what we're doing there will be attractive to some investors. I think the predictability, it's a very transparent model. And so the people who like to follow the Buffetts of the world, it's an easy, you can go through our presentation. It's not about geology. It's not about rock. It's not about so the generalist investor can just look at it, look at the numbers. We're very predictable. You can pretty much tell what our cash flow is going to be just by playing with tell me what the commodity prices are. So I think that's going to be something that's going to be well received.
Low cost operator and sharp capital allocation in a nutshell.
I think that's a nice combination. I'm fortunate that I've got really good people that help me on the operations side. Our team does a great job on that, and because that's not my expertise. Capital allocation, I do spend a lot of time reading, a lot of time following the markets, looking at different models. We're still the Chinese have a saying of crossing the river by feeling the stones. I mean, we're crossing that river right now, and what is the best model for dividends? What is the best, from a allocation and we don't know, but I'm pretty excited that we're now entering into that river. And I think we will, in the meantime, it's going to be a pretty good, we've had a nice run, I think, here recently with all the issuers. Commodity prices have risen. The tide's risen all boats. But I think we're still going to see differentiation between those that allocate capital really wisely and those that maybe don't. And it's going to be an exciting time to be an investor in this sector.
I think that's a great place to leave it.
Well, thank you very much. Very, very much enjoyed that.
I really appreciate your time and to get the summary on Pine Cliff Energy, and also to be someone else who reads Berkshire Hathaway.
There you go. All right. Thank you.
Hey, thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out roadsbros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.